Today is Monday, March 24th. Wanted to welcome everybody back from spring break and hopefully able to see that final shot in the Maryland game last night. Very exciting. This is the second attempt to record this video today. Fortunately, the first one was lost, so I am re-recording it. Today, what we're going to do is begin the third section of the class, which will be on valuation. And what that practically means is that we're going to be modeling out a reusable valuation model in Excel that is tied to Bloomberg. And over the next three classes, we are going to build that reusable valuation model using the company BMW. So I have placed into Elms, this is homework 8, in the files folder, a folder called BMW. And the file that you're going to need is valuation model BMW start.xlsx. Right. So make sure you download that file and have it ready to go, because basically everything that I do in this video, you're going to do in this video. And where I end this video is the same file you must have on your computer individually that you are going to submit for homework 8. You are not allowed to submit somebody else's file. You can't submit a file on somebody else's behalf. You have to create the file yourself. And so again, over the next few classes, we're going to value BMW. And then once we've done that, it'll take us about 10 minutes to do other companies. But we're going to be using this model pretty extensively through the second half of the semester. So while you're doing that, I want to mention a couple words about the Bloomberg Trading Challenge. The first half is over, and we are going to start the second half. So if you go here to Bloomberg, we're going to use the same teams we had in the first half, same team captains. So team message. And what you'll notice in your dropdown, say you're in section 101, this 101 section was the first half of the semester. And then what I did is I cloned it and created another one that says 101 2H. 201 2H, 301 2H, 401 2H. That's the second half trading challenge. Now, if you go into 101 2H right now, in section 101, the 11 a.m. section, you should notice it's blank. So I've reset this where everybody starts with $1 million. And so until you start trading, you're not going to see anything. But the same rules apply for the next 6 weeks. So the first one's still running, doesn't count anymore. But you can buy the same stocks, but you must have no less or no more than $300,000 by next Monday. So get out of cash this week and stay there the rest of the semester. You got to buy an additional 10 longs, right? Shorts don't count, but at least 10 minimum longs. And again, same rules apply as the first half of the semester. So this has been set up for all 4 sections. It is available now, and I'd recommend that you start trading now. Okay. So that's how you're going to start the second half of the Bloomberg trading simulation. You can buy some more stocks that you'd previously owned if you choose, but nonetheless, you have to rebuy them as if you're starting from scratch with $1 million. Everybody is now on an equal footing for the second half sprint. Okay, so back to Elms. So again, you're going to need to download this file. And just very quickly in the lecture notes, we're covering what's in the content of lecture note 3. But basically at a very high level, what we're about to do is this is the Modigliani-Miller graphic over here on the right. And we're going to essentially do a valuation based on the Modigliani-Miller format. So we're going to forecast operating cash flows to get free cash flow value. Use free cash flows to get operating cash flow value. We're going to forecast our non-operating cash flows. We're going to add the two together to get enterprise value, subtract the debt to get equity value divided by share price. Relatively straightforward process in a fairly complex model, but we're about to do a lot of Excels. Now, the file that you should have downloaded is this Excel file. Again, it's called Valuation Model BMW Start.xlsx. So let me share this file. All right, so this is what we're going to be working in primarily this evening. It's a series of worksheets that go from left to right. The first one is called model data. And this has 6 years of historical BMW income statement, balance sheet, and cash flow data in rows from 2024 going backwards. This data is coming from Bloomberg, right? And a very important thing, in order to build a standardized valuation model, we need standardized financial statements. Unfortunately, Bloomberg does not have those. So for example, they have 5 different income statement templates. They have 5 different balance sheet templates, depending on industry. And that's going to cause problems for our model. So what I've done is I've taken the raw data that we need from income statements, balance sheets, and cash flow statements. That's in the model data tab. And over here in this tab called income, I have created a standardized income statement. Okay. And in this tab, I've created a standardized balance sheet. So 6 years of historical data, 6 years of historical income statements, 6 years of historical balance sheets. And this you would have appreciated before. These balance sheets are then on this tab synced to TFIs that balance. The 6 years of income statements are synced to this tab of 6 historical years of TII that balances, which then leads to 6 historical years of CFI that balances, all using BMW's actual data. And then there's a tab for the balancing economic profit based on end of year data, which again balances. All right. So essentially, the other tabs in the model, there's one called ROIC drivers. These are the ROIC trees that you did in the second section of the class. This is exactly where they came from, this model. Okay. So essentially, these are the ROIC trees. They're auto-generated based on historical data for the company. There's a couple last tabs I want to mention here, and that is assumptions and ratios. So I'll start with the ratios. These ratios are income statement and balance sheet ratios, all as a percentage of sales, again, going back 6 years, with the one exception of the revenue growth rate, which is a percentage change in sales, right? So outside of the growth rate, everything is a percentage of revenue. And I did that intentionally to help build the model more easily and scale it up, right? And then the final tab I want to mention is called assumptions. Assumptions are just general assumptions that are not necessarily year specific. They're more universal. So for example, WACC, all right, since we're using a target capital structure, that's how we use a constant WACC over the valuation period. So it's not a year by year WACC that we're going to forecast. So that's why WACC is on the assumptions tab, as opposed to the ratios tab, where, for example, the tax rate might change year by year. Okay, so the year by year assumptions that change are in the ratios. The universal assumptions that don't change are in assumptions, right? And you'll notice here under the assumptions tab, these 3 cells are yellow, okay? Now I picked the color yellow. You can pick whatever color you want, but once we build this reusable model, which has a lot of formulas and a lot of things tied to other things, we don't want to accidentally break it. So if I go from BMW to Procter & Gamble, I want to know that if I put Procter & Gamble's data in, that I can actually change some things to get a valuation of Procter & Gamble. And I don't want to accidentally overwrite something in my model that's going to break my model. So what I've done is I'm using the concept of color to say things in yellow are things we can change. If it's not in yellow, you shouldn't be changing it, because you might break the model. Okay, so again, if you want to use different color, you can, but that's the concept of a yellow cell. Okay, so that's kind of a structure of the model that is laid out today. And so as we're building the reusable valuations, we're not going to completely start from scratch. We're going to kind of start with this kind of skeleton template that I've given you, and we're going to build from here, right? So what I'm about to do, you're going to do. You're going to copy everything I do from this point forward, and you're going to build, along with me, a valuation of BMW. When this video ends tonight, that is where homework 8 is ready to be submitted. You'll have until 10 a.m. on Wednesday to submit that file. In Wednesday's class, we'll pick up from here, wherever we end up tonight, and continue on. So we'll kind of work on BMW over the next 3 classes, right? So the best practice, a couple best practices that we're implementing here is number 1, everything is a percentage of sales, right? And that makes it easier to do the valuations. And the general format is we're going to forecast the ratios of a company, in this case, BMW, and those forecasted ratios will create the forecasted statements that we will use to value the company. Second best practice I've implemented is the idea of minimizing where your reusable assumptions are. I can tell you that if you put in changeable assumptions in all these different tabs, that you'll be up late at night thinking, why doesn't my Procter & Gamble model make sense? Because I used the BMW model and I copied it over, and I forgot that I put some assumptions here on the CFI tab that are the BMW assumptions that I didn't change for Procter & Gamble. So to mitigate against that, all of the changeable assumptions are either on the assumptions tab or the ratios tab. And that's a best practice that goes well beyond this class. Okay, you'll thank me for that later. And I'll mention a few others as we go along. All right, but back to our reusable model. All right, we have 6 years of historical data for BMW going through 2024. On the assumptions tab, cell B2 says, what is the last reported year? Look over here, 2024, because we're going to build a relative model based on this last reported year. It's already set to 2024. So we're going to start with ratios. So on the ratios tab in cell H3, our first forecast year, we're going to build a forecast, is 2025. So what we're going to do, relative reference equals previous year plus 1. And hit enter. Okay. So rather than hard code 2025, we're going to make it a relative reference. And that is very important, right? And the reason it's very important is because if, for example, I do another company that has 2025 as the last reported year, and I hard code this number, it's not going to auto update. So the model will continue to update as new data comes in. Okay. Now, the first ratio that we're going to forecast is the revenue growth rate. So back here in H3, as a placeholder, we're going to assume that 2024 repeats itself. So for 2025, H3 equals G3. So let's assume that BMW is going to shrink another 8.4% in 2025. Now, right now, that may not be realistic. We'll put in more realistic numbers in a later class, but just so we all have the same data as we're building the model, we're just going to kind of repeat the ratios of 2024. Now, since that is a cell that can change, I'm going to make that yellow. Okay, so that's a changeable forecast. Now, to show you how this is going to work, I'm going to go to the income tab, the income statements. And on the income statement, starting in cell H1, I'm going to identify this as a forecast because I have a lot of data on this page. I want to know what's real and what's forecast going forward. So everything on H going on is a forecast. The first forecast year in H2 equals previous year plus 1. So G2 plus 1 is 2025. And now I'm ready, plus 1, 21. And now I'm ready to do my revenue forecast in euros for BMW in 2025. So it's just revenue percentage change in revenue. So equals H3 equals G3, last year's revenue, times left parentheses, 1 plus, and then go to the ratios tab, H3, which is the 2025 revenue growth rate, right parentheses, enter. Right. So if BMW were to shrink another 8.4%, then its forecast for 2025 revenue would be about 130,368.65 million euros. Now, just to keep everything formatted in the same amount, I'm going to select from this cell all the way down to the bottom. And I am going to format that comma 1 decimal place, just to be consistent with the formatting of the rest of the spreadsheet. Okay. Now, I don't want you to do this. right? So don't do what I'm about to do. But for example, if we were to look in Bloomberg right now, stop, share, Bloomberg. And if I were to go to BMW, and if I were to go to the EEO, and if I were to go to the growth rate expectation of the analysts, right now, the analysts, are expecting BMW in 2025 to grow revenue 3.59%. That's current forecast. So what we would do in our model, go back to Excel, is 2025, I put in 3.59%. And I notice on my income tab, 147,491.4 euros. So that's the point. The ratios drive the number. That is a best practice in building out a modeling forecast. But I don't want you to do that. I'm going to undo this because as a placeholder, just to make sure we all have the same data, we're going to just repeat 2024 in today's class. Next class, we'll talk about putting in more realistic data. Okay? So the next forecasted number is we're going to have to forecast EBITDA for BMW in 2025. Okay. So again, and I should have done this before, in cell H1, make sure you also put the word forecast up here. Highlight that this is forecasted ratios. And again, equal the previous year. So approximately 14% again. That is a yellow cell. Depreciation equals the previous year. So H5 equals G5. That's also a changeable cell. Make that one in yellow. Then we get to operating income. Now, operating income is EBITDA minus depreciation. Since we have a forecast for those two, we're going to solve for operating income. So equals cell H6 is H4 minus H5. So operating income is 7.9%, but that's not something I put in as an assumption because it's based on the two above. So when you forecast this, you got EBITDA, depreciation, operating income, pick two, solve for the third. Right? This is the way that we're going to do it. Tax rate in 2025 might change. So equals H7 equals G7. And again, I'll make that yellow because that could change our forecasted tax rate. No pad or no plat, we're going to solve for it. Now, if you go over a column, you'll notice the previous year I put in the formula. Right? Formula for no plat is your operating income times 1 minus tax rate. If you want to be a little lazy, which I'm going to be lazy right now, take cell G8, copy it, go to cell H8, paste it, and basically paste that formula with a relative reference. So 5.5% no plat margin. And then finally, non-operating gains and losses equals the previous year. So H9 equals G9. And that's again something yellow because that might change. All right, those are the core operating items on the income statement, plus the one non-operating item that we are going to forecast for 2025. Right? So what I want you to do once you've done that is take column H, select it, copy it, go over to column M, select and paste. And so we're just going to repeat those ratios for 5 additional years. So we now have 6 years of forecasted ratios for BMW's income statement. Just to make this a little bit easier to see, I'm going to hide a few columns. Would not recommend you do this. Don't accidentally delete these columns. You'll screw up your model. Just so you can kind of see it all on one page. All right. So I basically have these are the income statement ratios. We got 6 years of forecasted ratios. And over here are the 6 years of historical ratios. The ones we can change in the forecast are in yellow. Now what we're going to do is we're going to take those ratios and we're going to build the forecasted income statements. So now we're going to work off of the income tab. Okay? So back to 2025. The next ratio down was EBITDA. So I'm going to go down to H8, right? And EBITDA equals for H8 for BMW equals ratios 2025 EBITDA as a percentage of sales. So H4 off the ratios tab times from the income tab 2025 revenue, which is H3 off the income tab. So if my forecast comes true, 18,232.2 million euros. Okay. Now you notice that we're skipping over cost of revenue and SG&A because the model doesn't really care. The model focuses on EBITDA. Right. Now I call it window dressing. In the real world, you would forecast those and they would lead to that EBITDA. But for simplicity, we're kind of skipping over a step. It's a very complicated model, and I don't want to give you extra steps that you don't really need to do the valuation. Okay, so we're directly forecasting EBITDA. Right. Next, we got to forecast depreciation and amortization. Similar process. So for 2025 equals from the ratios tab, H5, which is 25 depreciation and amortization as a percentage of sales, times income 2025 sales, H3. So we're forecasting the depreciation and amortization of the DA to be 7,920.3 million euros. Operating income, we solve for that. You kind of see the formulas over here on the left. So I take my EBITDA minus my DA, so H8 minus H9, and that gets me 10,311.9 million of operating income. So in about 10 minutes, we've just forecasted operating income and revenue for BMW next year. Okay. But we have some other items that we need to focus on, and I'm going to tell you how we fill out the rest of this income statement. Now, believe it or not, some of these other items don't have any impact on the valuation. If you ever want to change any of the assumptions beyond what I did in the model, you're welcome to later. But for now, I want you to kind of follow this roadmap. Interest expense. Because we're not going to change the capital structure of a firm, that's why I use a constant WACC, we're going to leave the debt alone, which means they're going to pay the same amount of interest. So for interest expense in 2025 equals 2024 interest expense, G11. For interest income, same thing. Because we're not buying back stock or paying out additional dividends, whatever cash they have, they're going to keep earning the interest on that. So for interest income equals the previous year, 690. For FX gains and losses, 0. I don't know what's going to happen to currencies. Neither do you. I was telling the class earlier today that I was doing a call with a multinational firm this morning, and we were talking about tariffs and currencies. And I asked them straight out, what do you think is going to happen and the impacts on currencies in the next 1 to 2 years? And they're like, we don't even know what's going to happen in the next 1 to 2 weeks. Like it's very difficult to forecast exchange rates right now. And so that's the point. We're not. We're going to assume most companies tend to hedge and try to get as close to 0 as possible. So for now, we're going to forecast 0. Has very little impact on the valuation anyways. So therefore, we're not going to put it in here to our simplified version of this model. All right. Income loss from affiliates equals the previous year, whatever it is, they keep doing it. So equals G14. And non-operating gains and losses is a ratio. So equals for non-operating gains and losses, H15, we'll go to our ratios, which will be H4, non-operating gains and losses as a percentage of revenue, times income, H3, 538.4. Now, you get to pre-tax income, see the order of operations over here. We take our operating income minus interest expense plus interest income minus FX minus income or loss from affiliates minus non-operating gains and losses equals our pre-tax income. Or, because I've essentially done that the previous year, you can take cell G16, copy it, go to H16, paste it, and the formula is in there correctly. 9,887.5 million of pre-tax income. Okay. Now you're going to pay taxes on that. So for the income tax expense, we're going to take the pre-tax income, 816, and we're going to multiply that by ratios 2025 tax rate, ratios H7. So they would pay 2950.6 in taxes, leaving them equals pre-tax minus the taxes, income before extraordinary items of 6,937,000,000 euros. So very quickly, we forecasted the vast majority of the income statement. Now we have extraordinary loss. By definition, an extraordinary loss or gain is non-recurrent. It's extraordinary. Happen out of the blue. So they shouldn't happen in the future. And we shouldn't know about an extraordinary item in the future because then it wouldn't be called extraordinary. So we are just going to call these extraordinary items zero. They're unknowable, right? So we're not going to forecast them. So net income before minority interest equals the income before extraordinary items minus the extraordinary item. Minority interest. Again, because we're leaving the capital structure alone, whatever minority dividends are being paid, they're going to keep paying. So equals the previous year, 388 million equals G21 of minority dividends this year, leading to overall net income to common shareholders is H20 minus H21. So very quickly, we have forecasted the BMW P&L all the way down to net income, 6,549,000,000. Right? But what we really are going to care about, so we're going to keep going, is we need to get to a change in retained earnings so that we can build proper balance sheets between the years. And essentially, as you know, net income minus dividends is change in retained earnings. So therefore, we're going to look at some of the cash flow items. Cash preferred dividends. Now, BMW does not pay preferred dividends, but another company might. So whatever dividends they were paying, they're going to keep paying. So for cell H23 equals G23, setting it up as a placeholder. Other adjustments to equity, zero. These come when FASB changes GAAP, right? Or whoever changes IFRS. So basically, when the accounting rules change, it's a bunch of paper, doesn't really affect cash flow, right? And they have to restate their numbers. That's what these other adjustments are primarily for most companies. Well, as finance people, we know that the paper pushers have zero impact on valuation. And I know many of you are going to go work for the Big Four accounting firm and get paid a lot of money to push a bunch of paper around. But nonetheless, what you do does not affect cash flow and therefore does not really affect the value of companies, right? So essentially, we're not going to forecast them because even if we did, they wouldn't affect the valuations. Zero. That gets us net income to common shareholders. And I want you to take cell G25, copy it, go to H25 and paste it, right? Giving us 6,549,000,000 euros in net income available to common shareholders. Common dividends. We're again not changing the dividend policy. So whatever dividends they were paying, they're going to keep paying. Equals the previous year. So H26 equals G26. Okay. Change in retained earnings. Net income minus dividends is change in retained earnings. But you'll notice that there's a little bit of a problem. Okay, over here, net income minus dividends equals change in retained earnings. If I do that, 6.5 billion minus a negative 3.8 billion, it's going to give me something like 10 billion of retained earnings. That's not the right number, right? So what I actually have to do is I equals net income, H25, plus the negative dividend, H26, to get change in retained earnings of 2768. This is another best practice to be aware of. We are tying this model to Bloomberg. Bloomberg is our data source. And I know that Bloomberg always gives dividends as negative numbers. I know on the income statement, Bloomberg always gives costs as positive numbers. So cost of goods sold, SG&A, depreciation, positive number. Preferred dividends, common dividends, negative number. Just the way Bloomberg does it. So because I know it's coming as a negative number, even though I'd be subtracting it, I'm adding the negative that I know is coming in to get to the number. This is why I'm telling you that this model is tied to Bloomberg, because Camp IQ may not do it that way. or Thomson Reuters may not do it that way. Yahoo Finance definitely doesn't do it that way. So the point of the story is, if you tried to reuse this model with another data source, it's probably going to break because the formulas assume the data is being fed in a certain way. And that's just a common problem we have in finance, that when you build these models tied to data sources, when you change data sources, it could cause problems in your model. So shouldn't this year, because you're using this model with Bloomberg, but I just want to make you aware of that, and that's why we're doing this. It's also why I had you add this or copy this number, because you'll notice this cell for net income available to common shareholders was the net income plus H23, which is the cash preferred dividends, minus H24, because I know cash preferred dividends is coming as a negative number from Bloomberg. All right, so we finished the income statement for 2025. So then what we're going to do is take that column H, select it, copy it, select over to column M, paste it, and we now have a forecasted income statement for BMW going through 2030 for the next 6 years. And you might say, why did he choose 6 years? It's part of the readings in the book. It's just arbitrary. But one of the things that's important in modeling is that whenever you do a valuation, you always do what's called an N+1 or a T+1 year. That would be this period. Okay. That is the start of your continuing value or terminal value period. This is our year-by-year forecast. So this model is set up that we will forecast 5 years individually. And then we'll say, starting in year 6 and beyond, that's our continuing value period. And so if I wanted to do 10 years of forecast, I do a year 11 for continuing value. If I want to do 3 years of forecast, you do a year 4 as continuing value. In this case, 5 years a year by year forecast, year 6 begins the continuing value period. But it didn't take long to build this forecasted model for the income statement. What we're then going to do is we're going to go to the tab called TII. We're going to take column G. We're going to select it, copy it. We're going to go to column M, select, paste. We now have 6 years of balancing TII for BMW based on those financial statements. The only thing I have to do is, starting in 2025, this is no longer history. This is a forecast. Caps lock on, don't shout. So make that forecast and copy this over. This is just going to be very important because a lot of data in this spreadsheet, and I need to know what's real, what's actual historical data, and what is a forecast data. So I delineate it by labeling the columns. All right, so we very quickly, a little more than half an hour or so, created 6 years of forecasted and balancing income statements and TII for BMW based on the ratios. Now we're going to turn our attention to the balance sheet. So back to the ratios tab. These are the balance sheet ratios that we are about to forecast. Okay. The reason I've chosen these balance sheet ratios is they are the ones that are driving the operating returns. Okay, so these are the operating items off the balance sheet in our standardized balance sheet. So our first year is 2025. So start with accounts and notes receivable. So that would be H11 equals G11. That is going to be a yellow cell because it can be changeable. And to save a little bit of time, because everything's just equal to previous year, take cell H11, copy it, select a range going down to M20, and paste it. Okay. So what that just did is it just repeated each one of those ratios equaling the previous year all the way through 2030. Okay. Now, the only one I didn't do is this last one called IC to sales. Right? IC to sales, 0.99. If we go back to our ROIC tree, is this. That's invested capital to sales. Measure productivity, right? So what we're going to do as a sanity check is I have a formula which will copy G21 all the way over to M21 and paste it. And right now it's 0 because we don't have a balance sheet. So there's no invested capital. This will change as we build the balance sheet. But it's kind of like a sanity check. So if you look historically, BMW has somewhere around 90 cents to $1.09 of invested capital sales. So if I'm forecasting BMW and I throw in, for example, a number like inventory goes from 17 cents to 67 cents. And suddenly that invested capital sales could be like $1.60. Well, if I look historically, that's an unreasonable amount of balance sheet for BMW. So it just kind of reins us in so that our assumptions don't get too far afield when we deal with forecasting. That's what that final number is. Just a sanity check, row 21, which we'll use this semester. Our next task is to take these balance sheet ratios. This is the most tedious part of what we're going to do, and create this balance sheet. So starting in H1, I'm going to label this a forecast. Relative reference for the year. So H2 is G2 plus 1. And again, you shouldn't do this because you might accidentally break your model, but I'm going to hide a few of these cells just so it's easier to see. So for 2025, the first balance sheet ratio we're going to forecast is accounts and notes receivable as a percentage of sales, right there, 29.1%. So we're going to repeat this process 11 times. All right, so going back to the balance sheet, go to accounts receivable, which is H6, equals on the balance sheet, on the ratios tab, 2025 receivables as a percentage of revenue. So H11 times, from the income tab, 2025 revenue, H3, enter. That'll give me 37,910,000,000 of accounts receivables next year. I'm going to take this column, go all the way down to the bottom, and format this, comma, 1 decimal place, just to be consistent with the rest of the model. All right. The next ratio down is the unbilled revenue. Now, BMW doesn't have any, but another company might. So we're putting it in here for that purpose. So equals, for unbilled revenue, we're going to go to ratios. Unbilled revenue is 0 in 2025. So H12 times income, H3. The next one is inventory. Equals, from the ratios tab, H13, inventory as a percentage of revenue, times income, 2025 revenue, H3, enter. Other current assets, equals, from the ratios tab, other current assets is H14, times income, 2025 revenue, H3. Oh, that'd be wrong. Start again. Equals, ratios. There you go. H14 times income, H3. 8,007.3. The next is the long-term investments. Equals. Go to ratios. Long-term investments, 40% of revenue. So H15 times revenue in 2025 off the income tab, H3. I might say, gee, why do they have such big long-term investments and long-term receivables? This is the financing unit of BMW. They have a wholly owned subsidiary, which basically does BMW financing, and that's where the car loans are. Net fixed assets equals, from the ratios, H16, 62%, times income, H3. Other long-term assets is the next one we're going to forecast, equals the ratios. Other long-term assets is H17 off of ratios times 2025 revenue, which is income H3. Then we jump to the liabilities, accounts payable equals ratios, accounts payable as a percentage of sales, which is H18 times income 2025 revenue forecast, H3. Almost done. Other short-term liabilities equals ratios, H19 times income H3. And finally, other long-term liabilities equals ratios, H20 times income H3. All right, so those are the key balance sheet ratios that we're going to forecast off the ratios tab. Now, so that's all of them. But these are the ones that are key because these are the kind of operating items that are important to our forecast. Now, I'm going to show you how to then finish up the balance sheet so that it balances automatically in a forecast without a circular reference. If you ever run into an Excel model with a circular reference, it's an invalid model. Right? And in this class, it will not be graded. So if you turn in an unbalanced model, CFI doesn't balance, or you turn in a circular reference, we're not even going to grade it. You'll get a 0 on the assignment. All right. So I'm going to show you how to avoid that. Right? So we're going to avoid that by finishing up the liabilities and equity section of the balance sheet first, starting with equity. All right. Starting right here, preferred equity, H28 on the balance sheet, equals the previous year. As I said, because we're targeting a capital structure, it's not going to change. If they have preferred stock, which BMW does not, but another company might, we're going to leave it alone. Same thing with the minority interest. If there's a minority stake in the business, they're going to keep it. Not going to add to it. They're not going to subtract from it. So it equals the previous year. The next one is share capital, and APEC is additional paid-in capital. They're not going to issue or buy back common stock in the future. So equals previous year. And then finally, we need to solve for retained earnings. Now, this is a formula, okay? And we know from accounting that the formula for retained earnings is equals last year's retained earnings, so G31, plus from the income tab, 2025 change in retained earnings. So 2025 is column H. It should go up by 2768, which is the net income minus the dividends. So the retained earnings should grow to 91,988. And if I sum these 4 items together, preferred stock, minority interest, share capital, and retained earnings, and add them up, I get total equity of 97,771,000,000 euros. Now we're going to go to the liabilities. Short-term borrowings in 2025 equal the previous year. Again, we're not changing the capital structure, so whatever short-term debt they have, they keep. Just like whatever interest they pay, they're going to keep paying. Well, now I can solve for my current liabilities. Equals the sum of the 3 above. Current liabilities are accounts payable plus short-term borrowings plus other short-term liabilities. 83,912.7. Long-term borrowings, that's long-term interest-bearing debt, equals the previous year. Pension liabilities equals the previous year. By law, you can't have unfunded pension liabilities grow over time, right? You got to pay them off. And generally, companies don't pay them early. So the pension liabilities, just like that, are just going to stay there on their balance sheet. Okay. And then we're going to add up our long-term liabilities. Sum the 3 items above. Long-term borrowings, other long-term liabilities, and the pension. And that gets us long-term liabilities of 83,210.3 million. Total liabilities equals current liabilities H22, plus long-term liabilities, H26. Total liabilities of 167 billion, 122.9 million. And then finally, total liabilities and equity equals total liabilities, H27, plus total equity, H32, 264 billion, 893 point whatever and change. So that's our forecast for liabilities and equity for BMW in 2025. Now I'm going to show you the trick to get the balance sheet to balance. It'll work every time. So go to total assets, which is H16, equals H33. The balance sheet balances. Ha 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 ha. It will always balance. All right. But the key is that all the numbers above are going to have to add up to that number. You got to balance the balance sheet, which means one of those numbers is going to be called a plug, which means it's going to force the balance sheet to balance because we're going to solve for it, right? And our plug is going to be excess cash, right? So we need to make sure we have all the other items except excess cash to make sure our balance sheet balances. The next item that we got to forecast is operating cash. So for 2025 operating cash, cell H4 equals, from the assumptions tab, operating cash is a percentage of revenue, B3, times, from the income tab, 2025 revenue, H3. So 2607.4 billion euros of operating cash. The only other item we need to do here is goodwill. Okay, goodwill comes from acquisitions. We don't know who BMW is going to buy, much less what they're going to pay for them in the future. Neither do they. So therefore, it's hard to forecast acquisitions. Now, we do know that technically goodwill could stay on your balance sheet forever unless it's impaired. So what we're going to do is we're going to say goodwill in H13 equals the previous year. Even if the goodwill is impaired, it's a non-cash flow item and has zero impact on the cash flow valuation of the firm, right? But it's just a placeholder to get our balance sheet to balance. So equals the previous year for goodwill. Now we are ready to plug the excess cash. So we're going to go to excess cash, which is cell H5, and we're going to put in the following formula. Equals total assets, so H16 minus everything else, minus operating cash, H4, minus accounts receivable, H6, minus unbilled revenue, H7, minus inventory, H8, minus other current assets, H9, minus long-term investments, H10, minus net fixed assets, H11, minus, or H11 and 12, minus goodwill, H13, minus other long-term assets. So I've accounted for everything else except for excess cash. I hit enter. I get 35 billion of forecasted excess cash, and most importantly, no circular reference. Now we're ready to do some window dressing. Total current assets. We're going to sum the 6 items above from operating cash all the way down to other current assets. So total current assets, 106,298. And for long-term assets, we're going to sum the 4 above that from long-term investments, net fixed assets, goodwill, and other long-term assets. 158,959. Now, I don't want you to do this, but if you were to take current assets plus long-term assets, our balance sheet balances. So the plug worked. So we now have a balance sheet for BMW for 2025. Once you get to this point, you will take column H, you'll select it, you'll copy it, you'll go to column M, select it, and paste it. You now have 6 years of forecasted balance sheets for BMW based on these ratios. Didn't take long. I think we're 45 minutes in. Next, because we have the balance sheets forecasted, we go to our TFI. Oh, before I forget, one other important change I forgot to do. So let's do it now. We made a mistake. Go back to H4 operating cash. Edit that cell. You notice there's no operating cash in these out years. Put a $B and a $3 into that formula. Okay. So assumptions, $B's, $3 times income H3, and then hit enter. And then take cell H4, copy it, and paste it over to column M. Problem is that when you copy and paste operating cash as percentage of revenue, it'll do C2, D2, or C3, D3, E3, etc. when you copy and paste this across. Problem is there's no numbers there. So Excel has something called an absolute reference. That's the $B, $3 that says when you copy and paste, always use cell B3. Okay. And so that's the one step that I had skipped that you need to make sure you do before you copy and paste. But nonetheless, these would be the balance sheets going out through 2030 that balance. We will then go to the TFI. We'll select column G, copy it, go to column M, paste it. And we now have, change this word to forecast, 6 years of forecasted and balancing TFI based on those forecasted statements for BMW that balance. And more importantly, if we go to our CFI, I could take column G, copy it, go to column M, paste it. I now have 6 years of balancing CFIs going through 2030 for BMW. And again, starting in 2025, this is the forecast. Differentiate here. So we took the ratios, we created the forecasted balance sheet. The forecasted balance sheet created the forecasted TFIs. The forecasted TIIs and TFIs created the forecasted CFIs. Everything balances, standardized model. Last step, go to our economic profit tab, take column G, copy it, go to column M, paste it. We now have 6 years of forecasted economic profits and ROICs that balance using both methods for BMW. And again, starting in 2025, that is a forecast. Copy that all the way through M1. This is homework 8. If you've gotten to this point, match these numbers exactly, you've completed homework 8, you could submit it for 2 points. If you did get to this point, you have between now and Wednesday at 10 a.m. to get to this point and submit this file. And it must match exactly. And the numbers, this is on the video, we're going to be looking for. The TAs grade this. I'm going to tell them to look at 2 things. Look at that final year economic profit down here. Should be negative 836.6. And more importantly, your CFI. Your 2030 CFI right there should be 4563.3. If you don't have that number, then you'll get a 0 on your assignment. Okay. And if you get these numbers, you're going to get a 2. Easy assignment. Match everything I did. Individually, can't share anybody else's spreadsheets. Can't turn in somebody else's. Got to do it yourself. And you might say, why is he being such a stickler for not giving me partial credit? And the answer is because, number one, I want us all to have a model that works. Because if I turn you loose on another company and I say, oh, go value Microsoft or go value, I don't know, NVIDIA or go value Procter & Gamble, then I want to have a model that works. And so by building this together, I know you will have a working model tied to Bloomberg. So when you get to the next part of the class, we're doing lots of valuations. We're going to be using this pretty heavily and relying on this pretty heavily. So you have to build this model. So in order to make sure we all build the right model, that's why I needed to match. Because if you match this, then I know you did it right. If you didn't match this, then you made a mistake. All right, go back through the video and figure it out. All right, so that is your homework assignment. We will pick up at this exact point and continue building on Wednesday's class. And that's going to be your next assignment. And by the way, I am not publishing this version of the model. If you don't create this model that works, you will fail all future assignments. Okay, so it is incumbent that you get this one right. If you're struggling, talk to the TAs. Right? But nonetheless, you shouldn't struggle because I kind of worked through step by step how to do this in the video. Okay, sorry this was coming a little late. I recorded this earlier today and it got lost in the Zoom black hole. So I am publishing this as soon as it finishes processing. Good luck and look forward to seeing you guys on Wednesday. Have a good night.